We're looking at GDP annualized quarter over quarter, and it comes in as expected as 3.5, same as last month as well. Personal consumption number comes in as 3.6, which is a little bit less than the 3.9 that was expected. The GDP price index, 1.7% as expected. Core PCE quarter over quarter, 1.5, slightly worse than expected. So for the most part, these numbers are coming in as expected, with maybe a hair worse. Like you said, the S&P was relatively buoyant coming in. And if you look at it over the last 3 weeks, the market is telling us that the Fed has pivoted at least a little bit. And the market's starting to take out some of the tightenings we had priced in for last year. So that's why these numbers are important, because with Powell speaking today and the slew of speakers we had yesterday, we want to look for confirmation that thesis is right. And these numbers are doing nothing to throw that off. The 10-year was 3.06 coming in. It's 3.06 now. Oh, also, by the way, you should throw in the fact that G20's this weekend. And I think the market feels that there's more likely chance of good coming out of that as well. You mentioned that the stock's been up the last couple days in a row, and I think those are the reasons. Fed, China. Back to you, Becky.
Okay, Jim, thank you for that. I want to check in with our guest host who's been listening to all of this and watching it, Blackrock's Rieder. Also, CNBC senior economics reporter Steve Liesman, who I believe we're going to get to in a second, is in Washington right now, ahead of, or not in Washington. You're right here, aren't you?
I'm in Englewood Cliffs, Andrew.
In Englewood Cliffs.
Remember that place?
I heard of it.
The mothership, so to speak.
Well, you know what? That I have you here, Steve. What's your quick take?
Well, I think there's an
important Powell later today.
There's an important and interesting change in the makeup of GDP here. Consumer spending downgraded just a little bit from 4 to 3.6, but what was upgraded was equipment spending and business investment. Remember, that was a big and notable weakness. It's still not as strong as it maybe should have been. It was 8.7% in the prior quarter. That was upgraded from 0.8 to 2.5%. So I think that's an important thing, because everybody said, what happened to business spending with the tax cuts? It's still weaker. It's still come off, but it's not sort of closer to zero. It's in that 2.5% range. And I do want to pick up where Jim had left off and talk about what Rick talked about earlier, which is this change in the outlook for the Fed. And you can see it by just going back to our prior Fed survey, where the outlook for 2019 was the debate between 2 and 3. We had 2.5 as the average number of hikes expected for 2019. And Rick just said earlier, I think in the show, said now the debate is between 1 and 2. So what's happened is a quarter point has come off here, and that's assuming that they add it at the end. And that's really, I think, the parameters of the debate right now. I think Rick's got it exactly right.
Rick, what do you think of that?
So I think that's fair. I think this GDP number won't do anything to the markets. The next one could. I mean, the next one you're going to see it decelerate a bit into the fourth quarter. Listen, I think most economists still have 3 to 4 hikes in their forecast for next year. As Steve said, the markets are debating a smaller number. I think the number.
But you think the markets are not? You think the markets may be debating it, but the Fed is not?
No, I think the Fed is quite frankly going to make a decision in December, and I think you're going to see a change in the statement. I think they're going to identify residential as being a drag or coming off the highs, and I think you will have a Fed that's going to pause and say, I still think they'll get another hike or two done, but I think in December they're going to describe something that's different in terms of how do you have to keep moving on this path of we're going to move every. By the way, now they have.
Rick,
yes, go ahead.
Can we just talk about something that I don't think gets a lot of airtime, which is, the Fed next year, if it fulfills the kind of plan, will reduce the balance sheet by $600 billion. A, do you think the Fed ought to go through with that? And B, what's the effect? Because in our survey, what we found is people think of that as the equivalent of a 35 basis point hike.
So Steve brought up what I think may be the point that nobody talks about in the system. We are draining so much liquidity. It's the draining of that. So do I think the Fed can slow down the reduction of the balance sheet? Yes. It's underneath the surface. You can't tell. The reason why liquidity is so difficult today is the Fed is reducing the balance sheet. The ECB is reducing the balance sheet. By the way, the Treasury is issuing a net $1 trillion a year of additional debt, draining liquidity from the system. And that's why you're seeing assets go out of equities, or people go out of equities, people go out of some of the debt markets, right into the front end of the yield curve, because they're draining so much liquidity from the system. So do I think the Fed should slow down the reduction of the balance sheet? I do. And nobody talks about liquidity, maybe the biggest thing that's hit the markets, the delta from where we were a year ago to where we are today.
When does that become a real problem?
It's become a real problem. That's why you see crises hit in places like in Argentina, like Italy to some extent. The pressure on liquidity in markets today is really difficult because you're draining so much from the system around the world. the delta of liquidity, we were going through for 2 years, massive amounts of liquidity infused in the system, and now you've reversed it 180 degrees. It's arguably a bigger deal than the debating the 25 basis points of interest rates.
Rick, that would be a huge reversal for the Fed, right? The Fed has said,
100%.
We are going to take this balance sheet reduction plan and we're going to put it over here on the side, and we're not going to react to incoming data as a result of it. So Jay Powell would have to kind of do a pretty good about face here if it was going to reduce that balance sheet plan right now.
No, I think at the end of the day, they're going to probably stop reducing the balance sheet probably around July of this coming year.
Wow.
That being said, I think, one man's opinion, people are underestimating this drain of liquidity that is literally a delta in markets from a year ago to where it is today.
Let me ask you a different question.
And by the way, it's why volatility is so much higher in the system.
The president, who's going to be going to Argentina later this week to be speaking with President Xi, said yesterday that he thinks that the Fed is a bigger problem or bigger challenge than China. Is that right?
So, you know, I wouldn't say necessarily the Fed's a bigger problem. I do think the Fed can adjust today. I do think the Fed can say, gosh, we've moved 10 times. Let's look at the data. The data does seem to be evolving. By the way, China's decelerating quickly. The European data is slowing, and you're seeing the interest-sensitive parts of the economy.
But what are you more, I guess my question is, as somebody who watches these markets, what are you more worried about? What Jay Powell does next, or what happens over this weekend, or at least what happens, or maybe even what happens, plays out over the next year or two in terms of our relationship with China?
So for me, I think the Fed is hugely important today. And I think that dynamic of where we're going in rates, where we're going in liquidity is a dramatically important thing. Listen, Chinese growth, you know, you're saying two things that are hugely important. If you said me what is third, it's hard coming up with what is third because Chinese growth is dramatically important to the system globally. And they're doing an awful lot to try and stabilize their growth.